We at the Fed understand the hardship that high inflation is causing.
When the Federal Reserve talks about raising interest rates, this is what most people hear. But listen closely, because they might have a solution to inflation.
We're strongly committed to bringing inflation back down.
We'll explain the thinking behind the highest interest rate hike in decades, and why some are concerned it could backfire.
They could actually tip us into a recession.
Plus, we're now in a bear stock market, what that means, and how to protect your retirement. Let's dig into it. Right now, American families have to spend $346 more a month compared to last year, all because of inflation. And it's leading to some really tough choices.
We got rid of a car.
It's a lot of other things I can't do because I have to pay for gas. You know what I'm saying? Less food, less playtime. You know what I'm saying? Because I got to put gas, I got to go to work, right?
Probably eat less.
Honestly, I've been looking at TikToks on how people grow their own produce at this point, just because it's getting so expensive to go and buy it from the store.
I don't know what they can or can't do, but they need to fix it.
Yes, they do. I am Ben Briscoe. We are going to dig into a new plan to lower those prices. The Federal Reserve just announced they will raise interest rates in the biggest increase since 1994. We'll explain why that can make a difference. But first, let's all get on the same page about why prices are so high right now. To understand why prices are going up, let's head back to Econ 101, supply and demand. When there is more demand than supply, businesses can raise prices. Over the past 2 years, how many times have you heard the words
supply chain,
supply chain,
supply chain?
Coronavirus shutdowns limited supplies. At the same time we came out of the shutdowns, people were ready to spend. Most Americans saved money when they weren't traveling and going out. Plus, we had all those stimulus checks and historically low interest rates, making it cheaper to get a home or car loan. More people wanted to spend all that extra cash, and businesses ran out of supply. So they raised prices. So now the Federal Reserve wants to pump the brakes on all that consumer demand and spending to help bring the prices back down. It increased interest rates by 0.75%, the largest jump in almost 30 years. That follows two other rate hikes from earlier this spring. Economists hope higher interest rates slow spending and tame inflation. If it doesn't work, things could get really bad.
The Federal Reserve has to thread this needle. They want to slow down the pace of inflation. But by raising interest rates, what's happening is they could actually tip us into a recession if they go too far, too fast. And the real hurricane could be if we're in a recession, still having high prices.
Federal Reserve Chair said today he expects other rate increases will be necessary in the future to get inflation totally under control. So we raised interest rates twice already, and each time there's proof the plan is working. Spending is slowing down. The Commerce Department says retail sales fell 0.3%. Furniture and home furnishings also saw drops, almost a full point. And since rates went up, home sales dropped 8.5% in March, then 16.5% in April. It's slow, but there is evidence showing the interest rate hikes are doing their job and slowing spending. Driving down demand, just part of the solution. The other part, increasing supply. President Biden said we're seeing some relief there too.
Delivery times are actually quicker than they were before the pandemic. And today there are about 40% fewer containers clogging the docks for long periods of time than there were last November. This May was the strongest month in the Port of Los Angeles' history.
The president says the infrastructure law passed in Congress last fall also helped build back supply chains. The act allocates about $175 billion to roads, bridges, and railroads. That helps truckers and cargo trains transport goods quicker, allowing supply to keep moving across the country. Look, high interest rates might have you spooked, but it could actually work out in your favor. We dug into 4 smart money moves you could make now to take advantage of the rate increase. The first place you're going to see your interest rates rise is your credit card. Call now and ask for a lower interest rate.
The credit card company's not going to call you and offer you a lower rate.
About 3/4 of the time, if you ask for a break, you can get it from your credit card company.
Number 2, consider transferring your balance to a credit card with a 0% introductory rate. But pay off the balance by the time the special rate ends.
Be careful with some of the introductory rates because as those go away, you can actually, if you don't pay off that balance, you may get hit with that higher interest rate.
3, improve your credit score. The higher your credit score, the more likely you'll qualify for a lower interest rate on loans. Credit scores can take time to improve, so start now. Go to annualcreditreport.com to get a free copy of your report. Make sure there's no mistakes.
People do make mistakes, companies make mistakes, and so you may see something on there that wasn't your fault and you can dispute that.
Higher interest rates can also be a benefit. Saved money will earn more money without you doing any extra work. So number 4, shop around for a high interest savings account. Look online for the best rates.
As long as they're FDIC insured, online savings is fine.
And that's how you keep an interest rate hike from emptying your wallet. Stocks bounced back a little today after news of the Fed's rate hike, but the S&P 500 has still gone down more than 20% since January. That means we are in a bear market. It happens whenever the market drops at least 20% from a recent high. Bear markets actually occur fairly often. The most recent one happened back in 2020 when the pandemic started. It can really be a blow to your investment portfolio, but financial experts say it's also an opportunity to make a ton of money.
All about now in this environment, losing less, so that when the market does come back, you're positioned to come back and gain more.
George Nassetti's a financial advisor. He says now is the best time to maximize your 401k contributions. When the market's doing poorly, it's a chance to buy low. The younger you are, you can afford to take more risk in volatile stocks. The older you are, your portfolio has to be more conservative with guaranteed fixed income.
Switching some of your equity positions to fixed income, which isn't going to give you a lot of return, but it's going to give you a little ballast to make your portfolio a little safer.
Depending on how diversified your portfolio and investments are, the answer could be to stay put, according to CBS News' money analyst.
You're not investing for the next 6 months. You're investing for decades in the future. You know, that little devil on your shoulder says, don't just sit there, do something. I turn it around and I say, don't do something, just sit there.
We can all agree the economy is in a tough spot right now. Coronavirus set us back big time in 2020, and it still makes it hard for us to recover today. But financial experts say if you make the right moves right now, you can set yourself up for success in the future and avoid any big fallout.